Every generation believes it invented fear of missing out. But the fear of missing out is far older than smartphones or social media. It's the ancient survival instinct of the human brain, now plugged into an infinite stream of financial opportunity. When we see others succeed, our brains don't register information. They register threat. Someone else's gain feels like our loss, even when nothing has been taken from us. In early human tribes, exclusion meant danger. Belonging was survival. That same wiring drives financial behavior today. When investors see a friend profit from a new stock or crypto project, it triggers the same neural alarm once used to avoid isolation. The brain interprets being left out as falling behind an emotional loss, mistaken for a financial one. Behavioral economists describe this reaction as social comparison theory. Developed by psychologist Leon Festinger in the 1950s, it explains how humans measure their value through others. In markets, this translates into comparison of wealth, returns, and timing. The feeling of being late to success activates the same stress pathways as fear or danger. Modern finance amplifies this instinct. A single viral post about a stock's sudden rise can spread faster than any corporate report. The emotional contagion of profit creates waves of imitation. The more people invest, the safer it feels not because of evidence, but because of visibility. Safety by numbers becomes a dangerous illusion. This is the essence of herd behavior, one of the most studied patterns in behavioral finance. Researchers found that markets move not only on information, but on imitation. Each person believes they're acting independently while subconsciously following social cues. The result is collective momentum built on shared emotion rather than shared logic. Economist Robert Shiller, who won the Nobel Prize for his work on market psychology, described these moments as narrative epidemics. Stories of success spread through societies like viruses, each retelling increasing belief. Fear of missing out is the symptom of those stories, an emotional fever caused by repetition. The brain's reward system reinforces it. Each time we see others profit, dopamine, the chemical of motivation, activates in anticipation. But the reward is not for gaining money. It's for closing the emotional gap between ourselves and others. This is why investors chase late rallies. The goal shifts from wealth to belonging. Fear of missing out turns opportunity into urgency. It convinces rational people that time is running out, that value will vanish if not seized immediately. This bias is called temporal scarcity, and it's one of marketing's most powerful tools. The phrase "last chance to buy" works because it mirrors the evolutionary fear of missing a hunt, a meal, or a mate. Modern investing platforms are built to feed that fear. Real-time updates, trending tickers, and social leaderboards transform financial markets into social competitions. The screen becomes a stage. Every rising chart feels like applause, every dip like embarrassment. The investor is no longer seeking returns, but reassurance. The paradox of FOMO is that it always arrives too late. When the story reaches you, the opportunity is already priced in. What's left is the echo of other people's success, a signal amplified by attention. Yet the brain, trained to chase inclusion, can't tell the difference between information and invitation. That chase defines the modern financial cycle. Fear of missing out drives buying frenzies, bubbles, and bursts. It's not simply greed. It's anxiety disguised as ambition, the fear of being the one who didn't act. Every generation rediscovers it in a new form. The pattern never changes, only the asset does. Fear of missing out isn't just an emotional glitch. It's a structural force that powers financial markets. Modern investing relies on attention, and attention thrives on emotion. The cycle begins with curiosity, rises into excitement, and ends in regret. Each turn fuels the next. The engine runs not on logic but anticipation. Behavioral economists describe this as positive feedback loops. When prices rise, more investors join in, pushing prices higher still. The rising curve becomes proof of its own success. Logic bends to narrative. The story of profit sustains itself until belief collapses. Every bubble in history has followed this same emotional script. In the late 1990s, the dot-com boom was defined by collective fear of missing out. Companies with no profits or even products reached billion-dollar valuations. The fear wasn't of loss, but of being left behind by the internet revolution. Investors didn't ask, "Is this business viable?" They asked, "What if this is the next big one?" The same psychology reappeared 2 decades later with cryptocurrency. The promise of instant wealth, amplified by social media, created an environment where every friend's success story became a trigger. Gains shared publicly created pressure privately. Fear of missing out became a financial contagion, spreading faster than the technology itself. Neuroscience explains why this pattern is so persistent. Fear of missing out activates two key systems in the brain: the dopaminergic reward network and the threat detection circuit. The first drives desire, the second warns against exclusion. Together, they create a paradoxical tension: the simultaneous thrill of potential gain and the panic of being late. This combination of reward and anxiety is addictive. Studies show that intermittent rewards, those that come unpredictably, release more dopamine than consistent success. That's why investors keep checking prices even when they know it makes them anxious. The uncertainty itself becomes a form of stimulation. In psychology, this behavior mirrors variable reinforcement, a concept from behavioral conditioning. The same principle keeps people playing slot machines. You never know when the next win will arrive, so the brain keeps seeking it. The market, with its flashing numbers and constant noise, is the world's most sophisticated slot machine. Social platforms intensify this loop. When influencers share screenshots of profits or once-in-a-lifetime opportunities, they weaponize visibility. Behavioral scientists call this social proof, the idea that if many people are doing something, it must be right. Yet in finance, social proof often means social risk. The crowd's excitement becomes the investor's vulnerability. FOMO transforms information into identity. Investors no longer ask whether an idea is good, they ask whether it represents them. Buying becomes belonging. Each trade is not just a transaction but a declaration: I'm part of this movement. The market becomes a tribe, and tribes do not question their stories. The fear of missing out also distorts time perception. Behavioral finance calls this hyperbolic discounting, the tendency to prefer small, immediate rewards over larger, delayed ones. Fear of missing out compresses the future into the present. It whispers that waiting means losing. The brain stops calculating returns and starts chasing relief. The irony is that most investors do not lose money from ignorance, but from impatience. The rush to join often comes when the risk is highest. Late entrants buy at peaks, hoping for momentum that has already faded. But in the moment, emotion overrides pattern recognition. Fear of missing out convinces people that this time is different. It never is. The emotional cost lingers long after the financial one. Regret triggers rumination, the endless mental replay of what could have been. Studies show that missed opportunities cause stronger emotional responses than actual losses. Fear of missing out doesn't end when the price falls. It transforms into fear of repeating the same mistake, keeping investors trapped in the cycle. The fear of missing out grows stronger in noise. The more updates we consume, the louder it becomes. To escape it, investors must relearn how to sit with silence. They must become comfortable with calm. Real wealth does not grow in movement. It grows in patience, in the quiet moments between opportunities. The first step is awareness. Psychologists call this metacognition, the ability to observe your own thoughts. When you feel the urge to act because others are acting, pause. Ask yourself a question. Is this decision guided by reason or by emotion? That moment of reflection is distance. It separates action from impulse and wisdom from reaction. Behavioral economists recommend what they call a pre-commitment strategy. It means setting rules before emotion begins to influence judgment. You might decide never to invest in anything that is trending on social media. The rule removes choice at the moment of temptation. A rule has no fear. It simply holds the line when the crowd rushes forward. Another protection lies in understanding probability. The fear of missing out convinces people that opportunities are rare and urgent. But behavioral finance research shows that opportunities appear again and again in new forms and new times. The wise investor accepts that patience multiplies chances. Waiting is not weakness, it is strategy. Experienced investors use checklists instead of emotions. They verify fundamentals, long-term trends, and their own risk tolerance before acting. The checklist becomes a stabilizer, forcing analysis before reaction. It turns a moment of emotion into a moment of measurement. The act of writing slows the pace of feeling. Technology can also be reshaped. Turning off notifications, limiting market updates, and stepping away from constant commentary all reduce mental noise. Neuroscientists call this stimulus control. The mind begins to focus again when it is not constantly interrupted. Silence becomes clarity. Focus replaces fear. Some investors use a technique called cognitive reframing. They learn to see another person's success not as proof of their own failure, but as a sign that success is possible. Someone else's gain becomes information instead of comparison. This shift transforms envy into insight. The feeling of threat turns into a lesson. Perspective is protection. Fear and greed are not opposites. They are reflections of the same desire, the need for control. Both come from attachment, from wanting outcomes to match emotions. The investor who learns to observe without clinging begins to act without panic. The less control you demand, the more peace you gain. Long-term investing is an act of imagination. It requires the ability to see your future self as clearly as your present one. Psychologists call this temporal self-continuity, the strength of connection between who you are today and who you want to become. The more vivid that link, the easier patience becomes. You start acting for growth, not applause. Missing out is unavoidable. No one captures every opportunity. The wise investor accepts this truth and stops chasing perfection. The goal is not to win every moment, but to stay present in every cycle. Regret fades when comparison ends. Time rewards those who keep showing up long after excitement has passed. The opposite of the fear of missing out is not carelessness. It is confidence, a quiet trust that patience will outlast panic. The market will always whisper urgency, and the crowd will always rush. But those who can stand still, think clearly, and wait long enough discover that true wealth is built in silence, not in noise.